Let's get some real expert analysis. Joining us now, Chicago Fed President Austan Goolsbee. Austan, thanks for joining us this morning. We have
good morning, Steve. How are you?
We've now had 3 of the 4 inflation reports we get in this nation. The most important come in the end of this month, PCE, but we can kind of calculate that. Take a step back. We know you don't react to any single inflation report or any single report. Give us your picture right now, or your sense right now, Austan, of the inflation story in this country right now.
Well, it's been a little mixed. It feels like the first 2 of the 4 came in quite mild, and we were feeling good. And I was saying here and elsewhere, if we get several reports like that, I'm going to feel comfortable that we're still on the golden path and things be okay for rates to come down. We put in a note of unease, I'd say, in the last CPI and now PPI, with the inflation kicking up in categories that are not obviously going to be transitory, which is to say the services inflation look to be turning up. So I feel like we still need another one at least to figure out if we're still on the golden path.
Were you looking, as I was this morning, into those import prices to see if they were the exporters were absorbing some of this, and now you don't see it? What is your sense of this number this morning? Usually, I don't know, in 23 years of doing this on TV, I've maybe talked about import prices 1 or 2 times before, but now it's kind of important, right?
Yeah, look, we're out sniffing in all sorts of places that are not normal to have to sniff. The thing about import prices to remember is they don't include the tariffs. In most of those cases, the tariffs will be on top of it. So if the foreign is absorbing, if the foreign exporters to the United States are absorbing the cost, those prices should be going down. If those prices go up and then you add the tariffs on top of it, that's a little bit the scenario. That's the unease scenario where, the costs are going up, and now we're in the business of trying to figure out, well, how long are those price increases going to last? Let's not overreact to 1 month of import price data, for sure. Let's not overreact to 1 month of CPI or PPI inflation, but it's at least an area of concern.
Austan, when it's come to rates, you've been maybe, what do they say? St. Augustine said, "Oh, Lord, let me be chaste, but not today." Your attitude has been...
I thought you were going to say brilliant and prudent, Steve.
Brilliant and prudent, yes, sir.
What is this?
Yes, sir, and chaste. But the thing is that you've talked about rates will come down over time, but you've been a little bit circumspect about the time over which they should come down. Could you give us your sense of that right now?
Well, I was pretty specific of the time frame in the run-up to April 2nd, and that I thought over the year they could come down a lot because we were at pretty much full employment and inflation was headed to 2%, and that's the thing that the FOMC by law is supposed to be looking at. What's happened is we've added a lot of uncertainty and we've added a lot of dirt in the air, which much of it has come from tariffs. And the tariffs, the theory that tariffs are a one-time price increase, that's true for one and done tariffs. And these haven't been one or done. And so we're trying to grapple with this idea of, is this going to be a persistent inflation shock? Is this going to be stagflationary in direction, which is to say it's going to be driving down employment at the same time as driving up prices? That's the worst thing the central bank has to think through, because there's not an obvious playbook. You got to sort of weigh off which of these is a bigger miss and how long is the bigger miss going to last. So you can't answer the question, when will we know that we're back or still on the path that we were on before April 2nd, without answering the question, is this going to be the end of the stagflationary shocks, or are we going to keep getting new policy administrations?
So when you say that and you talk about this, it sounds like you need some time at the least. And if you could, when you respond to that, also answer this question: how much does the Fed's stance about policy play a role in figuring out whether or not tariffs become a wider spread problem?
Okay, you know the rules. I'm not allowed to speak for the Fed or anybody else on the command. I can just talk about how I think about that. I think partly the conventional wisdom for how should a central bank respond to a stagflationary shock, which I think of tariffs as having a heavy stagflationary component. The primary effect, the Fed can't pump oil, the Fed can't adjust the supply side, but it can try to prevent the secondary impacts, which could be wage price spirals, or if you start thinking about the secondary impacts of tariffs on parts, components, supplies, and intermediate goods, now it's a little more complicated than the Econ 101 version, because now the tariff isn't just staying in its lane, it's going to be raising the cost of production for domestic manufacturing and others. And that's a lot of times, certainly during COVID and post-COVID, took time to wind its way through the economy. So I do think we're going to be in the business of trying to figure out which part of these price increases are we ignoring because we think they're transitory, and which ones are we responding to. Now, that doesn't mean that we have to hold forever or for as long as it takes for the prices to come back down. It all depends on the data and what's the economic outlook. If we keep getting inflation reports like the ones we had, the first two of these four that you mentioned, I would be very comfortable that, hey, the dust is out of the air. It looks like we're still where we were, which is a strong economy with inflation coming back down. In that circumstance, I think it's totally fine. It's expected. It's the right thing to do to bring the rates down to where we think they're going to settle. You know, we got to get some clarity from the numbers.
One thing we all hope for, no matter who we are, is that real wages go up, or weekly real wages keep going up. I mean, what else? Why else are we doing anything in this country, Austin? And right. And it's been pointed out. Yeah. You know, the Biden administration had a problem for the first couple, 2 or 3 years because of the inflation rate, and that was constantly harped on by critics that real wages, weekly wages, haven't grown. Now they're kind of stagnant again. And what you just described, I would imagine if the labor market weakens, you're not going to see people asking for more money, and if inflation comes back, then we could be stuck in the muck again, and that spells doom for current administrations when people feel like they have less buying power than when they started.
There's two parts to that. The political part, I joined the sworn member of Federal Reserve. I'm out of that part of the business, but you're an expert on it, Joe. I don't know what it means doom. I do know that's a mess. That's the mess of something moving in a stagflationary direction. Is no one's happy, and they shouldn't be happy. Prices going up, wages going up less than prices, incomes falling, but not getting any relief on the inflation side. That's what we want to avoid. We're going to have to see where we are. I still think underneath all of this, we were in a strong position on the economy going into April, and there are still a lot of strengths in the economy. So if we can assure ourselves or get a hint that for this meeting or the meetings this fall that we aren't on an inflationary spiral that looks to be persistent, I still think it makes sense, given the strength of the economy, to move rates more back to where we think they're going to settle.
Austan, I want to be clear about what you were saying. I want to make sure you finished the thought. You said if we get inflation reports like we got earlier, and by earlier, I think you meant before the ones this week, then you'd be fine to let through. But the ones this week, I just want to be clear, are they giving you pause about reducing rates?
They're in the space. I don't like tying my hands before a meeting, especially at the hardest thing the central bank has to do, as I always say, is get the timing right at moments of transition. So I want to get all the data we can, and I want to hear from my colleagues. It seems like people have some different views about what's happening. But the fact that services inflation for the single month was coming in at a rate we haven't seen in a long time, very high services inflation in that new data, that makes me a little uneasy because that's very unlikely to be caused by tariffs. So I'm hoping that was a blip. If that wasn't a blip, then that's an area of concern, and we're gonna have to grapple with that.
Austan, I want to have a conversation, a quick conversation, like we used to have when you were just a professor, and we'd meet at the American Economic Association annual conference.
That's
because
right.
One thing we don't talk about is what's happening on the employment side of the mandate. And you've started to talk about this, and some of your colleagues have as well, which is where's the break even anymore? Given what's happening in immigration and with deportations and what's happening with the labor force, we used to say, 100,000 is break even for the unemployment rate.
Right.
But now, if we did 50, would that cause you alarm as a Fed president that the employment market is weakening? Or do we need to move, I guess my question is, from thinking about the levels of employment to thinking about ratios of employment because of all the changes happening on the labor force side?
Look, I think a little bit, yes. You know, as I say, I just try to be a data dog, and one of the main rules of the data dogs is don't be too choosy about what you sniff, you know, whatever hits the floor. And we had a moment, we've had long moments where the headline jobs created number is the tentpole number that everybody wants to look at as an indicator of where we are in a business cycle. We saw in 23 and 24, when you have uncertainties about population growth, especially coming from immigration, but where you have those kind of uncertainties, you can get way off from where you think the break even is. And we had that in 24. We're coming in 150, 170, 190,000 a month. And we thought the break even was 85,000 at Chicago Fed. But that wasn't a sign that the economy was overheating. It was a sign that we were getting the population growth rate wrong. If we're in that environment now and immigration is going down, let's just be careful about over-indexing on that monthly payroll. And my intuition is exactly what you said. Those ratios and rates were a little bit better indicator of business cycle. So the hiring rate, the layoff rate, the job openings rate, and the unemployment rate. Those are kind of the four horsemen of justice in this thing.
And harkening back to something we talked about earlier on the show, Austan, could you ever foresee a Fed chairman with hair like Axl Rose, with like a David Zervos type ponytail? Is that in the realm of possibility? Is that in the realm of possibility? And not just because you'd be.
Wait, you think they need to be bald? What is your position?
I like bald as opposed to
bald.
Yeah.
I had a minute left for a question.
I'm not an anti-baldite.
I heard that there used to be in the Fed building. There used to be a barber. Yeah.
No, if he cuts it now, then he really wants it, right, Zervos? If he
comes on.
Yeah, if he suddenly comes on and he's high and tight, you know, like
shave the beard too.
Austan, thank you very much. Appreciate it.
Yeah, great to see you guys.
Please come again. It's a pleasure and a privilege to have you come on from time to time.
Thank you, Mr. President.
And walk us through these difficult times.
Thank you, Mr. President. Happy birthday, Mr. President. No, it's not.
Thank you, Austan.